Hello and welcome back to Chart School. This is Brandon Wendell from the Wendell Effect, and we're going to talk about candlestick basics in this video. We'll jump right into it. Just a quick reminder, we're not broker-dealers or investment advisors at TMO, Trading Mindset Organization, and we are not tailoring this information towards any particular individual or giving any personalized recommendations here. We are, as I said, not broker-dealers or investment advisors. So, past performance, no indication of future results. There's no guarantees with this education or information. There's a possibility you could have losses in the market, so do not trade or risk money that you cannot afford to lose. And we're also not subject to trading restrictions at TMO, so we could have a position in the markets or initiate one at any time. You can stay in touch with me. Feel free to email me if you got any comments or questions. Obviously, you can post them here as well and at brandonwendell.cmt@gmail.com. You can follow me on Twitter on a regular basis. I do tweet. And that's at TraderBW. You can also find me on the web, searching for the Wendell Effect on YouTube or Chart School, and of course, our new website, TradingMindsetOrganization.com. It'll be up and running if it's not already. So we're going to be looking at candlestick charts because they are the most popular way. They do show a lot of information very, very quickly and complete. So the four main things we really need to focus on when it comes to reading candlesticks. Number one, we need to understand color. Dominance of one color or another can be giving you a clue as to how strong and in which direction trend is in. If we get mixed colors, we have a mixed trend or trend weakness, which could lead us to changes in price. That's an opportunity. Shape. Well, taking a look at the shape of the candles, that can give us an idea of, basically where we close in relationship to high and low tells us who's dominating, bullish or bearish pressure. The size of the candles can also give us a clue as to how much bullish or bearish pressure is intact, or if we're needing more pressure. And finally, location, supply, and demand zone. So we're going to dive into all four of these in this video. Starting off with candlestick color, understanding bullish or bearish pressure on price. We have four prices in every candle, no matter what it is that we're looking at. A daily candle, a 5-minute candle, a 15-minute, it doesn't matter. Basically, the open is the first traded price during that particular time frame. Close would be the very last price during that particular time frame that was traded at. These are actual trades that have occurred. The high is the highest price the bulls were able to push prices up to, and the low is the lowest possible price that the sellers were able to pressure price down towards. So when we look at candles, we really have two main areas. We have the wicks, which stick out on the top and or bottom, and then we have the real body or body, which is the colored portion of the candle. So when we take a look at the candles, all four prices are represented there. The open, high, low, and close. Highs and lows are represented by the wicks. The close, though, that's going to tell us whether we get a green or red candle. Basically, if we close higher than we opened, the candle gets colored in green because we ended up a little bit more bullish or higher than we started during that period. If we have a red candle, it's because we closed at the bottom of that body and opened higher. Therefore, the sellers were a bit more in control and pushed us downwards. If we happen to have a candle with no color, meaning we open and close at the same price, some programs color that the same as the previous candle's color, but they're called dojis, D-O-J-I, doji. And it's basically a sign of indecision where we couldn't go anywhere during that period. So when it comes to candlestick colors as a whole, and a bottom of a market, what you're typically going to see are mixed colors. We got sideways movement in price, and mixed colors of the candles were very choppy and no real domination. But when we go into a nice uptrend, what you should see is a domination of green candles, more green candles than you see of red. When you start seeing the candles become mixed again, that's where we're nearing a peak in price. So we are starting to lose our bullish dominance and seeing that red coming back in. And then, of course, if the red becomes very dominant, we're probably moving downwards in a downtrend and seeing lots of red candles. Now, it's not always perfect like this, but for the most part, in this case, you're seeing mostly green. Yes, we do have some reds in there. Okay, it's not without any reds, but the dominant color is obviously green. And then as we approach this peak, what you'll see is a little bit of a change. Notice how we're getting mixed red and green back and forth. Now, we've had that before, but this one kept going, started making some lower highs as well. And then now we're confirmed in that downtrend when you start seeing those big red candles and a domination of red. Well, that usually will end when you're starting to see, once again, kind of mixed colors. We're getting a lot more green than we had before in that downtrend, so that downtrend may be ending. I want to make a note that it's not always one thing that you can look at. You can't just look at color or shape or size. You got to do it all in combination. And you want to take into context where you are in the overall trend as well. So here we have green candles started getting larger, dominating more, and we're back up in an uptrend. And the cycle just keeps repeating itself. And this can work on any security and any time frame. Our next candlestick shape, we have what's called the tail of the tails, T-A-L-E of the T-A-I-L-S. The tails tell a story. Basically, you want to look to see where did you close. And in this case, this is a green candle. We closed at the top of the body, but we closed away from the high. And what pushed us down away from that high was either a lack of buying pressure or there was a bunch of selling pressure. Anytime you have price action away from the high and you close away from that high, it's caused by bearish pressure being stronger than the buying pressure. Well, of course, we had this low being put in way down here, but we pushed way off that and closed higher. So any price action you get between the low and close is bullish pressure. So in this case, our green candle actually has a lot more bullish pressure than it has bearish. The next candle, we see it's a red candle, so therefore it closed at the bottom of the body. All green candles close at the top of the body, red closes at the bottom. In this case, from the high to the close, that's our bearish pressure, and we see it is quite large, a little more than half of the candle. And then we do have a little bit of buying pressure, but is much smaller than what we have in selling pressure. So this is a bearish candle. Our next candle is green. So you think, okay, maybe this is going to be a bullish candle. It's green. Well, wait a minute. Take a look at that closing price. From the high to the close is selling pressure, while the low to the high is buying pressure. Well, it's obvious that even though this is a green candle, there's more selling pressure than there was buying pressure. This is a bearish candle. So pay attention to not just the color, but the shape as well. Taking a look at a live chart, you'll often get clues. Not always, but you'll often see some clues. You see this domination of red. Now we're getting green thrown in there. But not only that, in the red candle, notice how the buying pressure grew a little bit compared to the previous buying pressures. You had very small bottom wicks here. Lots of selling pressure, obviously, but then there's some buying pressure that was greater than it was before. Another green buying pressure candle. We had a little bit of indecision, but still buying pressure on each of these candles, and then we rallied. Well, once we rallied, you could see where we stalled was when we had a large selling pressure coming in and causing that doji candle. Again, it's called doji because you open and close at the same price. It shows indecision. And not only that, we tried to make another high just after that, but yet we still had plenty of selling pressure. And we pushed back down. Tried to rally to a new high. We were met with a lot of selling pressure again, and prices retreated. So usually, not always, but you'll see selling pressure at or near highs, and you'll see buying pressure at or near lows in price. So the candle shape can give you a little bit of a clue as to where prices are going. We can also look at the size. Yes, size matters. Sorry. We got to watch the candle range. The size of the candle is the range. And I'm talking about the movement between the high and the low, not just the body, but the whole range of the candle. If you have a small candle range, it could be lack of activity. Or it could be that you have a lot of buying pressure, but also a lot of selling pressure. Either way, you have kind of indecision in price. It's not sure it wants to continue in the trend. If you get a large green candle, there's lots of buying pressure, but there's a lack of sellers, so that's a huge imbalance. However, if you get a large red candle, that's going to be lots of selling pressure, but a lack of buyers. Now, what's going to be very important with this is actually going to be the location of those large candles as well, because they both represent a bit of imbalance, either bullish or bearish. So in taking a look at an example here, you can see that we have a move to the upside, and at the end of that move, it's punctuated with a large green range candle, a large range candle, I should say, in green. Typically, when you see a large range candle after moving price, that's typically people chasing price. And you're not typically going to see the professionals chasing price. Those are typically going to be novices chasing price because they're afraid of missing out. So what happens is they chase price right to the end of the move. Same thing here. We started moving down, and as we broke down below the first big candle, you see that large red candle. Again, after a move down in price, those are novices now panic selling to get out for their loss. And that typically marks the end of a move. So when you see those large candles occurring after a move in price, they are typically the novices chasing price. If it happens near the beginning of a move, for instance, I didn't mark it off, but this red candle is quite a large range candle, and it's occurring after a sideways move. It's actually kicking off a new trend, and that's a big difference. I do talk about this in more of my courses in much more depth. Another example here, as you can see, we have it, well, first, really, right here, a large green candle after move down kicks off our move upwards. But we end our move, not exactly, it doesn't have to be at the very end, but it's very close. As you can see, the novices jumping in late, prices start to go a bit sideways. There's those small, narrow range candles for indecision before the reversal of the trend. Our last thing when it comes to reading prices, location, location, location. We call that supply and demand. And as I mentioned, I actually created a video on that before, identifying rally-based drop, drop-based rally, rally-based rallies, rally, drop-based drops, and all that kind of good stuff in another video called Supply and Demand. So there's the link for it if you want to check it out. I'll put it in the chat below as well. I want to thank you all for being here and being with us for another episode of Chart School. If you got any questions, please put them in the comments below or email me, as I said before. And I look forward to seeing you next time in Chart School.